In this video, we're going to go over the best 7 dividend-paying stocks that currently trade for less than $50 per share. These companies all pay out a dividend that is growing out each and every year. We have companies from various sectors of the market, and with the most recent transition we're seeing in the market, where people are selling out of the tech and moving into the value plays, we're going to go over some companies that might have some nice upside potential moving forward as we continue on with this transition in the market. Every single one of these companies has a safe dividend, and for each individual company, we're going to take a look at their current share price, the current financial position of the stock, and go over the dividend growth rate and dividend yield at this point in time. So if you're new here, everyone, I am the Gen Z investor, and every single day we talk about the stock market, we talk about different stocks you can buy and sell in your portfolio, like we're doing today with these cheaper dividend-paying stocks for under $50 per share, and of course we go over any major market news and headlines. This video was highly requested, so that's why we're going to go over the 7 dividend-paying companies that currently trade below that $50 price point. But one quick point I want to make before we jump into the first stock is that share price does not matter. A company can do something called a stock split or stock reversal and really manipulate that share price on the market. So what you have to take a look at is underlying company fundamentals, take a look at the actual financial position of the business and how the business is expected to grow. The dollar amount per share doesn't really mean too much for a company. Just because these companies trade below $50 does not mean they're considered cheaper or less valuable than a company that trades at over $100 or over $1,000. This is an in-depth topic that we're not going to go too in detail today. I just want to make that quick point out there before we jump into the first stock, which we're going to do right now. And we're going to get this one out of the way because it's AT&T. Ticker T currently trades for over $28 a share. This is probably one of the most popular high dividend stocks on the market right now. They have seen taken a beating over the past 12 months and are down 23%, with a market cap of $200 billion and the potential for 5G to drive this share price even higher moving forward. This is a dividend investor's dream. You can see they currently yield 7.34% and trade with a forward PE at 8.93. On the 52-week range, they are trading towards the low side with a 52-week high at around that $40 price point. So AT&T is held by a lot of dividend investors for that massive yield, and with the new 5G transition we're going through right now, there's a lot of potential for this company to rebound and set new all-time highs. But the one thing that kind of scares investors away is their high amount of debt. So AT&T does have a lot of debt on their balance sheet right now, but they are doing a nice job of reducing that each and every year, and they have a strategy to get that debt down to a more manageable level. And you can see here not too long ago, earlier this year, they announced additional early repayment of debt, which is a good sign, and they expect their free cash flow payout ratio for the dividend will be around that 60% range, giving them enough time and enough free cash flow left over to continue to reduce that high amount of debt over this year and into 2021 as well. And if we take a look, that current dividend yield is massive at over 7.3%. They pay out around 65% of their earnings, and they only grow their dividend at a rate of 2% per year over the past 5 years. So your dividend isn't getting a massive increase, but at least you are keeping up with inflation each and every year, which is a good sign, especially when you're getting that absolutely huge starting yield. And if we take a look, their dividend safety score is at 65, which is considered safe. And as I've previously mentioned, all 7 of these dividend-paying companies pay out a safe dividend. I'm not going to give you any companies that have a risky dividend where if you were to buy in over the short term, you can see a dividend cut coming in the next quarter or in the next 6 to 12 months. All these companies are considered safe, so unless something drastic happens in the market or in their individual business, we should see that dividend payment continuing to grow each and every year. The second stock on our list today is Pfizer. Currently trading at over $36 per share, they are only down 1% on the 12-month chart. And they currently have a market cap of over $200 billion, a forward dividend yield at over 4.1%, and a forward PE at 12.69. And of course, I'm sure you've heard the news, Pfizer has been making some great headlines as of late that their vaccine is more than 95% effective. This huge report hopefully can get this vaccine on the market very soon, and we can start saving people's lives throughout the end of 2020 and into 2021. And I'm sure this vaccine is going to really help drive the share price even higher, because if they can get this mass produced, distributed all across North America and into other continents around the world, I think it will really have some nice upside potential for Pfizer if they can be one of the main players distributing this vaccine over the next few years to help solve the pandemic. Their current dividend yield sits at 4.14%. They have a very sustainable payout ratio of only around 52.5% of their earnings, and they grow their dividend at a rate of over 6.7% averaged over the past 5 years. So you're locking in a very nice high over 4% starting yield that is growing at a significant rate each and every year. And if we take a look, their dividend safety score comes in at 75, which is considered safe. So we're not really worried about a dividend cut over the short term as well. Moving on to the third stock on our list, we have Aflac. Currently trades for $43 a share, down 19% this year, but as of late they have seen a slight recovery, getting closer back to that pre-pandemic high. Their market cap for this insurance company comes in at around $30 billion, and the company has been posting a very strong dividend history. Their forward PE is only at 8.94, so a lot of value coming in with this company right now. And their forward dividend yield comes in at 3%, and trading towards the center on the 52-week range. For Aflac, earlier this week, they also made a huge announcement increasing their dividend by around 18%. That is an absolutely huge dividend increase from this dividend aristocrat. And I love seeing these massive growth rates from these different companies. So you can get a company right now with a 3% current dividend yield, a massive 18% dividend increase for the next quarter. And if we take a look, they only pay out around 26 to 27% of their earnings. There's so much money staying back into the business in order to grow operations, and there's so much room to help grow that dividend payment moving forward. And they still have a massive dividend growth rate averaged of over 7.5% over the past 5 years, with a 38-year dividend growth streak. So this is a dividend aristocrat, and they have the highest dividend safety score possible, considered very safe at 99, with a massive 18% dividend increase over the past week. This may be a nice company you want to add to your portfolio for a nice growing dividend under that $50 price point. Stock number 4 on our list today is Cisco, ticker CSCO, currently trading around that $41 price point. They're down 9% this year, but they have seen some consistent ups and downs over the past 12 months, and they have a market cap at $173 billion. They trade at a forward PE at around 13 and on the low side of the 52-week range, with a current dividend yield at 3.5%. If we take a look, that nice 3.5% starting yield is right within that average territory, but they only pay out 45% of their earnings. So another company with a lot of room to continue to grow that dividend payment over the next few years. And of course, their dividend growth rate is at over 13% averaged over the past 5 years, which is absolutely incredible. So you're locking in a nice 3.5% starting yield, which is on the average or slightly higher side compared to the market we live in right now. And that dividend payment is giving you a raise of over 13% average each and every year, which is absolutely massive. And tie that in with a 91 dividend safety score, we're not worried about a dividend cut coming anytime soon from Cisco. Now we're moving on to number 5, and it is CocaCola. Currently trades at $52 per share. So yes, they're slightly above that $50 price point, but as of late, they have seen a little bit of an increase that is coming to pull back. So the share price shot up as of late, but you can see here a slight downward trend, which I'm sure we might be able to get them below that $50 price point over the next few weeks. This company is a dividend king. They've been around for an extremely long period of time and have a market cap of $225 billion, a forward PE of around 28, and a dividend yield at 3.1%. They have some strong future expectations. They've been expanding very nicely. They've made some nice acquisitions in other continents outside of North America. In Europe right now, they're really growing some of their small businesses nicely. And if we take a look, they're forecast to have a 9.2% rise in earnings per share in 2020 and an 8.4% rise in earnings per share throughout 2021. So overall, we're expecting some nice growth rate from Coca-Cola moving forward, and that increase in earnings per share is going to help get this payout ratio into a more sustainable range. So the current yield at over 3.1%. They have been growing that dividend at a rate of 5.5% averaged over the past 5 years. 58-year dividend growth streak. They are a dividend king. The payout ratio at 86% right now is on the higher side, but I'm sure once we can hit those new earnings per share estimates, they can get that earnings per share number bumped up. Its dividend payout ratio will come back to a more sustainable range in that 70-ish% average. If we take a look at their dividend safety score at 80, considered safe, another company where they've been around for such a long time, the dividend, I believe, is still safe. Although the payout ratio is still higher, they have some plans moving forward. I like this dividend safety score coming in at 80. Stock number 6 is Hormel Foods. So this company was trading below $50 a share when I was planning this video. When I was putting this list together and doing my research, they were trading below, but you can see here yesterday's trading day on Friday, they increased 14 cents, putting them at $50.13, so just above that $50 mark, but I'm keeping them within this list. Up 17% this year, a market cap of $27 billion, and you can see they have a forward PE of around 30 with a dividend yield at 1.86%. So if we take a look, their cash flow from operations was up 59% in Q3. So during a pandemic, during a tough time for the overall economy where there's a lot of increased costs that have been hurting free cash flow, this company was able to post a massive increase in cash flow from operations over that consecutive quarter, which is a great time to see. If we take a look, they have a current yield at 1.86%. They still only pay out around 55% earnings as a dividend, so it's so much room to continue to increase that dividend payment moving forward, and they have been doing just that. It's very impressive to see companies with a payout ratio that's still sustainable at only 55%, with a 54 consecutive year dividend increase streak, so they've been doing this for a long period of time, and they still average absolutely huge 16% average dividend growth rate over the past 5 years. So you're getting a company like this, a dividend king, a lower starting yield, but that dividend payment has been growing at a massive rate that's been around for a long period of time with a 54-year streak and a sustainable payout ratio. A lot of good signs from this type of company. And they have the highest dividend safety score possible with a 99, a very low beta, so not a lot of share price volatility. This is another company you may want to check out for your portfolios. Moving on, the final stock we're going to take a look at today, it is Comcast, ticker CMCSA, a 5-letter ticker, very unusual, below $50, coming in at that $49 price point, up 11% on the 12-month chart, and a $224 billion market cap. This company currently yields 1.87%, but they only pay out 36% of their earnings as a dividend and have a massive 5-year dividend growth rate average of over 13%. So of course, another company, lower starting yield, but a massive dividend growth rate each and every year, and a very sustainable payout ratio with lots of room to grow. And they have a very safe dividend coming in at 89. So of course, another company, no issues or no worries of a dividend cut coming anytime soon. So those were 7 different companies, all trading below or around, I'm going to say, that $50 price point. These are companies with some solid dividend histories, pay out nice growing dividends each and every year, and could be a nice addition to your portfolio. So if you really enjoyed this video, please hit that like button and subscribe. It really does help the channel grow, and I appreciate everyone who takes the quick second to do just that. So thank you for watching, and see you in tomorrow's video.